Okay, so um, in this lesson, we're basically going to be going over the different market orders, the Greeks, like what the different Greeks are and why they're useful, as well as like what, when we say averaging or when we say to average down, like what exactly that means and what exactly averaging is, especially, in relation to options contracts. So moving forward here. So what exactly are the Greeks? So the Greeks are different variables that were created to manage risk. And, in options trading, the Greeks allow the trader to really understand profit and loss as share prices move. So if there's one thing you should know about options is that they're not just based off of share price. So we use the Greeks in order to see the other variables that affect the options, the premium of the options contract. So we can see, what exactly affects the price of an options contract due to the fact that it's not just share price that affects that. And there's 5 different variables, or also known as Greeks, and these include delta, theta, vega, gamma, and RHO. And nearly every brokerage has like a section where you can see the Greeks, whether that be TD Ameritrade and their Thinkorswim platform. When you go to trade, you can see the Greeks off to the left side, and we can show you that later if you're confused on that. But Robinhood, you just scroll down on your trade, and it'll have a little box that says Greeks, and it'll have delta, theta, vega, gamma, and RHO. So it is difficult to understand what impacts the value of an options trade because of the fact that it doesn't move based off of share price, like I was saying. So since it doesn't move based off of just share price alone, just like if you were trading normal shares of a company, there is other factors that influence the price of the options contract, and the Greeks allow us to see these. So the Greeks do not actually determine the pricing, but instead show you how the options contract could be priced. Just give me 1 second here. I'm going to mute these people so that doesn't interfere. So yeah, so I was just saying the Greeks do not actually determine the pricing. They're just an estimate of how the options contract could be priced. And just a little note here, I do include every single thing I'm saying in the PowerPoint because of the fact that I want people to be able to reference what I'm saying. And I did type up a lot of this. So, I want people to be able to go back into the chat and be able to reference this information. And, if they weren't able to, pay attention or were confused on something, they go back and study this, do their own research along with, what I'm teaching here. So that is the reason for literally everything to be in these PowerPoints. But so moving on to the 5 different variables that I was talking about, I included a little infographic in the top right corner just as a quick summary of each one. But basically, the delta measures the change. Give me 1 second. I'm gonna mute everybody this way.
God damn, mute your mics, yo.
Yeah. Sorry about that. All right, there we go. Just muted them. So moving on to these variables here. These are the variables I was talking about. Delta measures the change in options price when the stock price moves up $1 in the stock. Calls are positive and puts are negative. So just to explain this so it makes a little more sense. The delta shows you how much the options premium of the contract is going to change for every increase or decrease of $1 for every increase of $1 in the stock. So, if you're trading calls and there's a $1 increase in the stock, then the delta is going to be positive due to the fact that you're going to profit if the share price of the stock goes up. So delta allows you to see the effect that share price has on the options contract. And gamma is the rate of change of delta based on a $1 change in share price. Think of it as how much more profit you'll make if it goes up another dollar after the delta. And this can get confusing to a lot of people, but the easiest way to think about this, and I've explained this many times, is literally gamma is how much delta will change after the delta goes up. So let's say, I'm trading Apple, and let's just say hypothetically Apple's at $100, right? Apple goes up $1. It's at $101. Let's say we have a $100 call, right? The delta is going to tell me how much that how much the options contract is going to go up if Apple goes up to $101. Remember that $1 increase in the stock. And then gamma is going to tell me how much the delta is going to increase on that next dollar increase. So now if Apple increases to $102, right? Now the delta is going to change because it already increased $1, but now it increased a whole another dollar. So again, you usually add the gamma to the delta, and then that's a $2 change. And that can be a bit confusing, but I can reference you to some other materials. I can sort of show it to you visually, actually of showing you actually like it drawn out and how it actually works. But I personally don't really look at the gamma all that much. I mainly look at delta and theta. So moving forward, theta is probably one of the most important Greeks here, and it's because it's what shows you that time decay. So the amount the price of the calls and puts decrease by every single day is what theta shows. So as the option nears expiration, it obviously decreases because options contracts are a decaying asset, which means as time passes, they decrease in value, right? So the theta allows me to see how much the contract price is going to decrease the next day, just automatically based on how close it is to expiration, as well as other factors. So, if I have theta is always negative due to the fact that options is a decaying asset. And, this can be very useful because, if I'm getting into a trade and the theta is very high, like I'm not going to want to hold that trade overnight because that's an instant loss. It could be an instant 40, 50, 60% loss when I can just look at the theta and be like, okay, maybe I'll get an expiration date that's further out. This way, I don't have to take that loss instantly in the morning. So, it's as you near expiration, it's definitely something that becomes really useful in sort of choosing your expiration dates. And a lot of people, when do we choose the expiration? Do we choose this Friday? Do we choose next Friday or the Friday after that? And, the theta can kind of help you gauge that, as well as, what's fundamentally going on, as well as whether you're trading a day trade or a swing trade. Because, if you're day trading, then you might as well get the closest expiration, unless you have, unless you're thinking about swinging it. But, that's basically what theta shows you is the, how much the options premium will decrease the next day as it nears expiration. So vega is the amount the calls and puts change every 1% change in implied volatility, and it's basically it forecasts the movement in share price based off of the implied volatility. And I personally don't really use vega, and you'd have to really understand implied volatility in order to understand vega. So that would be explaining implied volatility would be a whole lesson itself, because there's so much that goes into implied volatility. Whether that's learning how to use the implied volatility indicator to gauge an earnings play or something like that. Implied volatility can be really important, especially when you're trading options, because volatility is really important in options. But if you're looking at the Greeks, I'd mainly focus on the delta and the theta, because those, in my opinion, are going to be the two most important ones. Because if the delta is not at a place like where it's reasonable, then there's no point in getting in that trade, because there's not a lot of reward. There could be more risk. You look at the theta, and it's a high number. But and then RHO is just the rate of interest, and we basically we don't look at RHO, because RHO is used for longer term trades because it's the rate of interest. So if you're looking at your trades like 6 months plus out, then you would use RHO, but we don't use it, so we're not even gonna delve into RHO, because it has like literally no use for day or swing trades. So moving on here. So like, how can we actually use these Greeks, when we're trading? So the Greeks can be used to judge risk, and they basically allow the trader to have a better understanding of the price movement. Like I said before we went into the 5 different variables. So you can use this to see how, how much you're going to profit, or, how much risk there actually is. And when we talk about risk versus, risk versus reward later, and, portfolio sizing or whatever we delve into, the Greeks can ultimately help you gauge how much risk you're actually taking in that trade for options contracts, of course. So completely switching gears here, we're moving on to the different types of market orders. And everybody that's trading should know this already, unless you're really, really just starting. But the different types of market orders are basically the different types of orders you can set in your brokerage to, for your trades. So if you're trading on Robinhood, all options contracts are limit orders. You can't change it. When you're trading on Thinkorswim, or you're trading on, any other platform really, you're able to change the kind of order that you have. So a market order allows you to buy at the current price no matter what. So let's say Apple's trading at 101.95. I send my order in. My trade's going to execute at 101.95 or whatever price I said. It's going to execute at that current price. Let's say in the half a second that it takes me to click the send button, Apple shoots up or shoots down $10. It's going to execute at whatever it is once that order goes through. So, that can be risky depending on how fast the stock is moving, and as well as other factors. But, that's why some people don't like using market orders, because of that risk associated, because it executes instantly. And, if Apple changes like $5, which is, not common, but if you're trading a more volatile stock, in those couple seconds that you send an order, you can take a loss instantly due to the fact that you sent a market order. But a limit order allows you to buy a certain price and only at that certain price. So if Apple's at 101.95 and I set my limit order at 101.93, my order will only execute at 101.93. If it never reaches 101.93, then it will never execute. So that's one downside to a limit order. Your order might not go through, because let's say you set at 101.95 and Apple moves to 101.96 and just stays above 101.95 for the rest of the day. Then your limit order will not execute, and you'll miss out on that trade. So that's one downside to limit orders. But a lot of traders do like to use limit orders because of the fact, they're not going to get that instant loss or instant gain right from the start because of the order. Stop loss is when it executes below a certain price and turns to a market order once it reaches that price. So you set a stop loss at a specific price point. So let's say it's 101.93. Once Apple drops below 101.93, it turns into a market order and it sells at whatever it's at. So that's one advantage to a stop loss. It's going to sell no matter what if it drops below 101.93. Obvious disadvantage is it's going to sell at whatever it's at once it drops below 101.93. So if there's a huge drop, it's going to sell at whatever it's at. A stop limit will convert to a sell order at the limit price instead of becoming a market order, and it will only execute at the limit price better. So basically what that is below a certain point, it will only sell at that limit price. But, those are the different types of market orders. I believe Mo is going to delve into, what exactly, or how exactly you set a stop loss in Thinkorswim for those of you trading on Thinkorswim. But you can't set stop losses on Robinhood, which is one disadvantage of Robinhood. So you just kind of want to, watch it instead of mental stop loss. If I'm at, let's say 10, 15% loss, just cut it there. You know what I mean? Depending on the trade, of course, it's going to differ from trade to trade.
100%.
But we'll go over some different risk management after this PowerPoint.
Yeah. Thank you, Andrew. That was great. Yeah, I mean, I'm gonna touch bases on just some basic stuff. Risk versus reward. I just want to speak on A lot of people
Yeah,
have
yeah. We
different
just
account
have we
sizes.
have one more slide on averaging that I,
Oh
included
yeah,
as a
yeah.
little
Oh
thing
yeah,
at
yeah,
the
yeah.
end
Go
here.
ahead. Go ahead.
Um,
Absolutely.
I included this just because, sometimes people ask like, what is averaging down? Because, sometimes we'll say like average down on this, and people will be like, what the hell is averaging down? So, averaging is literally just buying more of a share at a lower price than it was originally paid, so that it lowers the average you paid. So let's say, I'm trading Apple at $102. I buy it at $102, and Apple goes down to $100, right? I've now got that $2 loss, but I'm still very confident that Apple's going to go up, right? So I'll buy more at $100, and now my average will be lower than $102, and it will, as it goes up, I'll profit more, or I'll break even at a lower point, and that's just basically averaging down. The only risk of averaging down is you're buying into a losing trade most of the time, because you're already losing, and then you're going to buy more. If it keeps going down, you're going to lose more. So unless you're really confident that that trade is going to go the way you originally thought it was going to go, you shouldn't average down. But it depends from trade to trade. Obviously, you're not going to always average down, and it shouldn't be something you do every single trade, because really you're just buying into a losing trade. But I had one person who's trading Tesla. They took a loss on Friday based off of their own trade. They traded Tesla and they were down, which, they're trading shares, so they can just average down and then, wait for that pop that's going to come and recover everything at a lower break-even point. So that's just one advantage of averaging. And that's it for the PowerPoint. So, Mo, if you wanted
All
to touch
right.
base
All
on
right.
anything.
Yeah. No, that's great. That's great. Yeah, averaging down is something important, but also knowing when to average down. Just to touch up
Exactly,
on
yeah.
that last slide, because a lot of people think they see the reversal and then they get tempted to buy maybe 2 or 3 to average down based on how much they have already sized in. Don't do that unless you actually do see confirmation for that reversal on all time frames. Meaning, if you're watching, let's say, a 5 minute, confirm it on a 1 minute, 5 minute, and let's say a 10 minute. And then if you see confirmation for that reversal, then that means you can go ahead and average one, and then upon the confirmation, average another one, and then boom. If you were at 50%, God forbid, 50% loss, from there you retrace down to 25. And then that means you only need 25% to be back into profit instead of needing 50% to be back into break even and then to profit. So that's key. But also something to touch bases on is risk versus reward. Um, a lot of people, they look at, we mentioned everybody has a different account size, but a lot of people look at the expensive premium contracts, and they tried to always make a move on the more expensive premium contracts instead of playing the lower premium contracts. Like, let's say, for instance, the banks like Bank of America, Visa. We always speak about, let's say, Costco, Microsoft. All that stuff is lower premium. The contracts are not that expensive. Maybe Costco is mid premium. I wouldn't say lower. But I'll say, ACB, CERON, CGC, we'll speak about, the weed sector, we'll speak about USO. All that stuff is considered lower premium contracts, meaning you can size up correctly. You can add to your position anytime. If you need to average down at any position or anytime you have enough capital. And for the people that have smaller capital, that's the way to approach. Instead of going with $500 and buying one Tesla contract that's going to the upside, you can size up on BABA contracts a little bit out of the money, or you can size up on AMD or MU, and et cetera, et cetera, et cetera. So that's number one, risk versus reward, meaning also in the spread. Some people see the move, they see the run, they're tempted. They're like, oh, you know what? The stock BIIB, let's open it on the chart here. Biogen has an insane run. Let me jump on that momentum train and try to catch it to the upside. Well, guess what happens? You buy the contract. Whoops, cut out for a second. I'm back. So you buy that contract, and you're hoping that as soon as you get filled, you're hoping it will go to the upside. And based on the spread, based on how spaced out it is, you end up being in negative move. Although the stock is moving to the upside, maybe you got caught on the spread and you got filled on a higher average. And then by the time you sell, you get out negative, you get out flat. And a lot of people, that's something that happens, is they see the chart, but they don't own the fundamentals or the basics of buying. Looking back at what they're supposed to do as option traders, which is looking at the spread, looking at the Greeks, touching bases on what Andrew mentioned, looking at your theta, your delta, you know, because let's say if you're in a day trade, it doesn't go your way, for instance, you know, stock goes flat, you're not up, you're not down, you want to your theta at that point? Are you in the money? Are you at the money? You know, what's your expiration? All that stuff matters, you know, as a trader. So don't put yourself in a position where your risk versus reward is not there. You know, you're risking a lot more than you're getting rewarded, then that's not necessary. Don't dig yourself a hole. We always speak about digging for yourself a hole. And that's something we also in our you know, education tab. We mentioned about it in our risk management and psychology tab. It just mentions if you're in an initial loss of 8%, the gain needed to recover is 8.7%. If you're in a 25% initial loss, the gain needed to recover is 33%. Now notice, the more your initial loss is, how your gain needed to recover is going to start getting more. If you're at a 30% initial loss, your gain needed to recover gets to 43. If you're at a 40% initial loss, your gain needed to recover gets to 67. You know what I mean? And last but not least, when your initial loss is at 50, your gain needed to recover is 100. So all that stuff matters. Don't dig for yourself a hole. Don't put yourself in that position. Always cut your losses early. Let your profits run. You know what I mean? And that's something for a lot of people is sometimes during a trade, they want to put that the idea that it's going to come their way, or they want to prove themselves right. They want to prove that the direction is there, the technical. And, you know, that's where your ego steps in and you're like, you know what? I'm just going to hold it. I'm going to go through it. I'm going to slice through it. And that's the point where, you know, you have to understand that why am I holding? What's your reason of holding if you were to do that? Why wouldn't you cut that loss earlier? And depending on what your contract is looking like let's say some people have their expiration is in a day. Your theta is going to eat up, or your expiration is in 2 days, or it's in even 3 days. And you know, it's a risky. The stock took a bust. It flushed for like 10 points to the downside, or vice versa. You know, went to the upside and you had puts. You know, don't put yourself in that position where your premium gets screwed and theta gets eaten up. And you know, your risk is really, you know, eating up your reward. So that's just something we want to speak about. Setting a stop loss on Thinkorswim, you know, is fairly easy for a lot of people. We want to just go over Zoom. I know I was thinking maybe if Andrew can log in from TOS.
Well, I was thinking because we're gonna get cut out here soon. I was thinking we record a whole separate video.
We can do a video on YouTube. Yeah, we can do a video and post it actually on YouTube. The 3 types
and
of
we'll put it
orders
in
and
our
how to
chat.
place
We'll
them.
put it in the chat too. So
Yeah, that works. That works. Yeah.
So people can always reference that, and they don't have to watch.
And I know we're limited on the
video
time.
just to find
Yeah, and
out.
I know we're limited on the time of this recording as well.
Yeah.
From Zoom, I think it's like what, 30 minutes or 40 minutes.
It's 40.
Yeah. So that's just the first thing I wanted to touch bases on. So don't put yourself in a position, you know, your risk and reward isn't there. I also wanted to speak on, you know, a few things this week. You know, this is for the pre-market notes, but you know, we're in the lesson side for now. And I want to touch bases on, you know, let me see here, the thetas, the Greeks, I'm sorry. I want to speak about theta decay.
Yeah, one thing while you're speaking about that is I wanted to touch on your sizing on day trades versus swing trades.
Yeah.
When you're swinging something, you should always be swinging lightly. Unless like you've got some sort of information or something that you know for a fact that it's going to go up, then maybe you go in, you know, medium-sized position. But you should always be swinging lightly, because swings are a lot more dangerous because you have that theta, you have a bunch of factors. Something can happen overnight. You know, if it's something happens during the day, we have, you know, the ability to get in and out really quickly. So, but we can't do that overnight. So if something happens and, you know, it tanks overnight or tanks in the pre-market, there's not really much you can do. So you want to swing lightly if you do swings. Day trades, you can size more into day trades because of the fact that you're able to get in and out instantly. You know, you're able to watch it and see how it's moving. You're able to look at the patterns. You know what I mean? When you're doing an overnight swing, or, you know, you're swinging over 2 to 3 days, you have to be careful. You know, one way to be careful is by going in lightly. So.
Yeah, be smart. Proportion sizing is key. That's one. Two, you're going through a storm, right? When you're a swing trader, you're going through everything. You're going through in the Trump area, you're going through the Trump tweets, you're going through news, you're going through a few things. So you have to have that side of emotion, kick it out of the window. because as a long trader, you don't want to be like, oh, I just bought it, I'm negative 4% or 3%, and the stock is actually just consolidating, or it's moving in it's basic support and resistance. It's in a channel, or it's trading in an upward direction. Nothing's going on in the stock. And some people really have the issue of, they're like, oh, I'm down 1% or 2%. So don't put yourself in that position. As a swing trader or as a long trader, you want to be able to be in the position and ride through because you see the technical and it's there. You want to watch bigger time frames. You want to watch the 30-minute, 5-minute, 10-minute, 15-minute. Don't start watching the 1 minute, sitting in front of it and seeing the stock turn more red candles than green, and be like, this swing trade is not going to go my direction when you just bought on Monday. Your expiration is like 2 weeks out or 1 week out. So focus on TTP. Trust the process. Focus on on the strategy. Focus on getting to the prize. Focus on the direction that you're going towards. Don't get distracted, and that's what happens in the market. A lot of people read a piece of news, all of a sudden they think, you know what, that's the piece of news that's going to make the market tank. No, that's not necessarily how it works. So know exactly what affects that type of stock, what type of news affects which sector. All this stuff matters. So this week we have a lot of stuff going on. I just want to speak about moving averages, some basic technical analysis. I know some people asked me, Mo, what do you use? I said I use the 9 SMA. I appreciate you, Mo. Somebody asked, Mo, what do you use? I spoke about, I use the 9 SMA, the 9 simple moving average, not the 9 EMA, not the 9 exponential moving average. I do have it on a different setup here, but I use the 9 SMA purposely because I feel like I don't get faked out of the trades more. For some people, they like the 9 EMA. So just focus on what works for you. I like the 9 SMA on a bigger time frame. I like the 180 SMA as a swing trader. So I don't say that I completely rely on indicators for trading. And the indicators sometimes do get laggy, but they give you kind of that little extra insight on what you're seeing, whether it's a bigger time frame, whether you're a swing trader, a long trader, a short trader, a scalp trader. You kind of see a little bit extra, with the relative strength index. You see, the volume, you see a bunch of extra stuff. So indicators kind of do give you a little push, but you can't slightly rely just on indicators to trade, right? Because a lot of people be like, oh, I entered a call when the MACD reversed to the upside and it crossed over, but I got faked out. Well, I'm sorry, you shouldn't just buy when the MACD crossed over. You look at it this way: how many white flags did you have to enter the trade? How is your RSI looking? How is your your momentum? How is your volume? Was your volume picking up? How was it on the 9 EMA? Was it under it? Was it climbing over it? Did it bounce off the lower VWAP? So there's a lot of questions you want to start asking yourself. And if everything's lined up, you see, let's say 4 white flags and 1 red flag. The red flag is maybe volume isn't really there as much. Everything else is lined up. Okay, so you want to see exactly in proportion and RR, risk versus reward. See, okay, do I enter this trade based on all the flags that I just saw, or the trade isn't really necessarily worth it at this point? Let me find a better trade that sets up. Let me find a better entry or a better reversal or a better breakdown or a breakout. So as a trader, that's what you want to focus on. Some people get discouraged. They're focusing on that one stock. They're upset that that one stock isn't going to their direction, or they want to master that one stock. So they want to be like, oh, you know what, NVIDIA or Baba is going to go to 184 now. And what Baba doesn't really go to 184. They get tight. They feel like they don't know Baba. That's not the case. You might know Baba and you know the strategy. Sometimes the stock won't follow because the market is choppy, because news isn't there. So always remember, don't get discouraged. Don't overtrade. That's the key. Don't overtrade. Something, the risk versus reward. A lot of people don't understand. A lot of people have a certain target they want to hit daily because that's how they think, oh, I want to hit like 500 a day or 200 a day or 200 a week. And that's how they try to focus on trading. But that's not how it is, because in the back of your head, once that happens, it makes you force a trade or makes you push a trade. And it happens to all of us. You don't want to be put in a point where you feel like you're forcing a trade. Something. Some people I used to know, they used to have rent coming up and they would use their rent money to trade with it and try to double it before they pay their rent. And one time it didn't really hit their direction. They were tight on rent money. So don't put yourself in that position, where you feel urged to trade with that money. Proportion size, use your risk management. Even if you have 200, 500, 1,000, 10,000, whatever the amount is, use it right. If you proportion size correctly, If you wait for confirmation on entries, there should be no reason that you're not winning. And also, don't trade on the days that there's too much news or too much chop. Just, close it up. Close up the day. Be like, you know what? Today's not the day I want to trade. Protect your profits, protect your wins, and take a step back and don't over trade. And that's something that happens to most of us. We want to take advantage of the available buying power, the available day trades, or today I have all 3 day trades available. In some people's different cases. I think that's unnecessary. You can have all day trades available in one day, but if you push trades with all 3, you're going to burn them out and not make any money with all 3. And then boom, you're back to swing trading and you're forcing swing trades. You know what I mean? And especially with what we're seeing, not every day is a swing trade. Not every week is a swing week. Not every day is a day trade day. So you got to focus exactly what's going on and kind of align your strategy. And that's what we're doing as we work together in progress. If any of you guys have questions, this is kind of why we do this as well. Touch bases on lessons, Q&A. We will have a side that we're going to run about pre-market notes, a few stocks we're looking at into tomorrow in a little bit. So I'm not going to take much of your time, but this is, it's been a great session. We spoke about everything. If you guys have any questions right now, feel free to type it up.
I actually have a question, if you don't mind me cutting you off.
Yeah, absolutely.
So looking at delta and theta, can you just give us a range of what's a good delta and what's a good theta to work with? Because it's me being all new and completely clueless here.
Okay,
So
right.
Delta
So, I mean, it depends what you're trading, right? Because you could have a contract with a higher premium price. So, let's say I am trading Apple and the premium price is like $1.50, right? That's going to be different than if I'm trading, let's say Facebook and the premium price is like 20 cents, right? Because then if the delta is, let's say, 0.3, right? The 0.3 is going to have a lot greater of effect on Facebook than it will on Apple because, it's a lower premium price. So it's really, it depends on what you're trading. Normally,
so
as
let me give you an example, if you don't mind.
Yeah, no,
Sorry,
go ahead.
So right now I'm on the call. I'm on the 175 call with Roku. I'm pretty sure almost everybody in the group is on that call. The delta is 0.1264. Is that a good number? A bad number?
Let me pull it up. You said you're on what was it?
The 175 call for November 29th for Roku.
Okay.
So the delta is 0.1264.